Florida's rental scene is unraveling in ways hardly anyone saw coming. For years, the Sunshine State pulled in waves of newcomers, real estate investors, and Airbnb hosts who thought the money would never stop flowing. But as we move through 2025, everything has flipped. Rental prices are sliding, empty units are piling up, and property owners who once boasted about unstoppable demand are now quietly freaking out. On today's episode of Discover the Cities, we're breaking down the 10 Florida cities where rental markets are deteriorating faster than anywhere else in the U.S. And if you live in one of these places, or your name is on a property deed there, consider this your early heads up. Number 10. Ocala, Florida. Ocala has long had a reputation for peaceful living, quiet horse country, wide open spaces, and prices that made it a haven for retirees, medical staff, and families who wanted a slower pace. But as 2025 unfolds, this calm little city has been thrust into the spotlight for all the wrong reasons. Ocala is now experiencing one of the sharpest rental downturns in the entire state. Recent reports from Apartment List and Zillow show that Ocala's rents are dropping at a pace few medium-sized Florida markets can match. Prices are falling far more quickly than local wages are rising, leaving a growing disconnect between what developers thought would happen and the reality taking shape. Back during the pandemic migration wave, people poured into Ocala from Orlando, Miami, Tampa, and even major northern metro areas. Builders reacted quickly, maybe too quickly. Florida Realtors data shows that more than 6,000 new rental units were approved in Marion County from 2020 through 2023, marking one of the biggest construction surges the region has ever seen. Entire complexes shot up along State Road 200 in Silver Spring Shores and throughout rapidly growing neighborhoods outside downtown. But by the time 2025 arrived, demand started slipping away. According to the Bureau of Labor Statistics, job growth slowed noticeably across Ocala's main industries, especially in healthcare and logistics. Major employers like Advent Health and the Regional Medical Center pulled back on hiring, and the distribution sector, once booming, cooled off as national freight activity weakened. Population growth has also lost momentum. Census estimates reveal that far fewer people are relocating to Marion County now that remote work perks have faded and many families are rethinking the cost of moving. With fewer newcomers entering the area, landlords suddenly find themselves chasing the same shrinking group of renters. Entire complexes built during the boom years are scrambling to fill units, offering incentives the city has never really seen before. Weeks of free rent, no deposit move-ins, slashed application fees, even gift card bonuses just for signing a lease. CoStar shows vacancy rates climbing above 11% in multiple communities, a clear sign the market is oversupplied. No one expected Ocala to become one of Florida's softest rental markets. Yet here in 2025, that's exactly what's unfolding. Too many apartments, not enough tenants, and a downturn far more severe than anyone anticipated. Number 9. Daytona Beach, Florida. Daytona Beach may be famous across the world for its racing legacy, beaches, and constant stream of tourists, but behind the roar of engines and the flow of seasonal visitors, its 2025 rental market is flashing clear warning signs. According to CoStar, several submarkets across Daytona have now crossed 10% vacancy, marking one of the fastest vacancy increases on Florida's East Coast. What's surprising to many is that even with strong tourism spending, long-term rental demand simply isn't keeping up. A big part of this traces back to the construction rush that took place from 2019 to 2023. Developers greenlit thousands of new apartments along the LPGA corridor near the Speedway and throughout beachside areas, assuming remote workers, retirees, and hospitality employees would quickly occupy them. But reality hasn't matched those expectations. New data from the University of Florida's Bureau of Economic and Business Research shows population growth in Volusia County slowing to one of its weakest rates in almost 10 years. With fewer households moving in, every new building adds more competition. Landlords who once comfortably raised rents are now lowering them in an effort to keep tenants from leaving. Another major shift is the cooling of the short-term rental surge. Daytona became a hotspot for investors trying to cash in on vacation bookings, but soaring insurance premiums, tougher local regulations, and softer occupancy numbers have pushed many owners to abandon the vacation rental model entirely. Those properties are now re-entering the long-term rental supply, dropping hundreds of extra units into an already overcrowded market. CoStar and Zillow alike show noticeable declines in asking rents, especially across recently built complexes. Property owners are rolling out incentives that were unheard of just a few years ago: move-in bonuses, lower deposits, reduced monthly rates, and large concession packages. Even upscale communities near the Speedway and along the riverfront are offering deals no one expected to see. In 2025, Daytona Beach finds itself dealing with an oversupply of new construction and minimal growth in permanent residence. For landlords, this iconic coastal city has turned into one of the toughest rental environments in Florida, marked by rising vacancies and steadily falling rent prices. Number 8. Port St. Lucie, Florida. Port St. Lucie used to be one of the brightest success stories of Florida's pandemic-era migration wave. Families fleeing Miami, New York, New Jersey, and even California flocked to the Treasure Coast in search of more space, lower costs, and modern housing. The city expanded so quickly that it ranked among the fastest-growing metros in the entire United States. But the landscape in 2025 looks nothing like the boom years. The rental market in Port St. Lucie is cooling at a pace that has caught nearly everyone off guard. Zillow's rental data shows that asking prices have been steadily declining for over a year, signaling a shift from a red-hot market to one now flooded with supply. CoStar reports that vacancies across the Treasure Coast have jumped noticeably, with some of the larger apartment communities reporting 10% or more empty units. In simple terms, Port St. Lucie built far more rentals than the current population can absorb. During the height of the migration frenzy, developers rushed to keep up. Entire districts packed with new apartment buildings sprang up throughout Tradition, Torino, and St. Lucie West. At the same time, investors scooped up thousands of single-family houses, convinced Florida would deliver an endless stream of renters. But when inflation soared nationwide and insurance costs spiked across the state, many potential movers reconsidered uprooting their lives. The steady arrival of newcomers, something Port St. Lucie depended on, began to taper off. Population growth in St. Lucie County has essentially leveled out, and data from the University of Florida's Bureau of Economic and Business Research shows job growth failing to meet earlier projections. This combination means fewer renters entering the market while hundreds of newly built units continue to roll in. Investors are now battling one another for tenants. Homes that were snapped up within days in 2021 are now sitting empty for weeks at a time. Owners who bought during the market's peak are slashing prices just to maintain cash flow. Discounts, lower deposits, and even free months of rent are becoming increasingly common. Port St. Lucie isn't facing a crisis, but it is undeniably dealing with oversupply. Too many rentals, too few renters, and a once unstoppable boom now revealing the consequences of building too fast for too long. Number 7. West Palm Beach, Florida. For years, West Palm Beach stood out as one of the most sought-after rental markets in all of South Florida. Its coastal charm, a lively and rapidly developing downtown, and a steady wave of newcomers from Miami and the Northeast kept demand extraordinarily high. Apartments leased almost instantly, and rent prices seemed to break new records every few months. But by 2025, that unstoppable momentum has started to slide. West Palm Beach is now showing unmistakable signs of a rental cooldown. Data from Redfin and Realtor.com reveals that the city's median asking rents have begun to decline compared to last year. CoStar is reporting rising vacancies not only in downtown high-rises, but also in buildings along Okeechobee Boulevard and in communities throughout Northwood and Village Commons. These vacancy increases are far above what developers predicted during the peak boom. One of the biggest reasons behind this shift is the slowdown in corporate growth. During the pandemic era, West Palm Beach became a magnet for finance companies and remote professionals relocating from New York, New Jersey, and Chicago. That sudden influx pushed rental demand through the roof. But over the last year, hiring pipelines have cooled off. Remote work trends have leveled, and the number of high-earning renters coming into the city has dropped more than developers expected. Palm Beach County's overall population growth has also weakened. With fewer newcomers arriving, the once strong stream of renters has thinned noticeably. Yet construction never hit the brakes. Between 2020 and 2024, the city approved thousands of new rental units, from downtown towers to projects in Northwood and around the Brightline station. Much of this fresh inventory hit the market exactly as demand softened, leaving a clear oversupply, especially in the luxury segment. Landlords are now pivoting fast. Concessions that used to be rare are becoming standard practice. Move-in bonuses, zero deposit move-ins, discounted first-year leases, and generous incentive packages. Even upscale buildings that used to fill without effort are now offering deals to avoid empty units. West Palm Beach isn't in a crash, but the adjustment is impossible to ignore. A glut of new construction, fewer relocating professionals, and slower employment growth have created a rental landscape far more competitive than anything the city has experienced in recent years. In 2025, the market is resetting, and property owners are definitely feeling the strain. Number 6. Kissimmee, Florida. Kissimmee was once the epicenter of Florida's short-term rental boom, the place where Airbnb dreams turned into real money. Just minutes from Disney World and surrounded by nonstop vacation traffic, the city became the top destination for investors during the pandemic. Entire blocks were snapped up by out-of-state buyers convinced that nightly bookings would keep rolling in forever. But by 2025, the mood in Kissimmee has flipped completely. The city has become ground zero for rental market anxiety, and the downturn has hit harder than almost anywhere else in the Orlando region. Apartment List shows that Kissimmee is now seeing some of the sharpest rent declines in the metro area. The biggest reason? A massive oversupply created by the collapse of the short-term rental model. Insurance premiums skyrocketed, county regulations tightened, and occupancy rates for vacation rentals plunged. Thousands of Airbnb hosts abandoned nightly bookings and dumped their properties onto the long-term rental market all at once, far more than demand could absorb. CoStar reports that vacancy rates across Osceola County have surged, with some large apartment communities posting double-digit empty unit percentages. The result is a wave of concessions: 2 months free rent, complimentary amenity upgrades, cheaper renewal rates. Even upscale vacation homes are being offered for long-term leases at prices far lower than they commanded just a year earlier. Tourism has bounced back, but tourism industry wages haven't kept pace. Many hospitality workers simply cannot afford the rental rates landlords expected, especially as rising insurance and property taxes push ownership costs higher. That mismatch leaves unit after unit sitting unoccupied. Migration patterns are also shifting. Data from the University of Florida's Bureau of Economic and Business Research shows that the inflow of newcomers into Osceola County has slowed significantly. People who moved to the area during the pandemic for cheaper living are now confronting insurance bills and cost pressures that look more like South Florida than Central Florida. As a result, many are relocating once again, this time to more affordable inland cities. Kissimmee has become a textbook example of what happens when an entire housing market leans too heavily on short-term rental profits. The outcome is predictable but painful: too many units, too few renters, and landlords fighting to stay solvent. In 2025, Kissimmee is no longer the paradise for vacation rental investors it once was. Instead, it has become a market in full retreat. Number 5. Jacksonville, Florida. Jacksonville has long been known as one of Florida's biggest and fastest expanding metro areas. With major military installations, a growing port, and sprawling suburbs that kept attracting newcomers from the Northeast and the Midwest, the city seemed unstoppable. During the pandemic years, rents surged at some of the fastest rates in the entire nation, and developers rushed to keep up with the demand. But in 2025, the situation has flipped completely. Jacksonville's rental market is cooling far more sharply than most analysts anticipated. Vacancies are climbing, new units are sitting empty, and property owners who once enjoyed effortless leasing are now feeling a very real squeeze. Fresh data from CoStar shows a large swell in available inventory across the metro. Areas like the South Side, Bartram Park, Town Center, and the North Side are seeing newly built apartment communities struggle to fill units that were expected to lease instantly. Some buildings are now dangling incentives like 2 free months of rent or waive deposits, the kind of concessions usually reserved for severe downturns. So what triggered the shift? One of the biggest culprits is Florida's statewide surge in insurance costs. Skyrocketing homeowners and property insurance premiums have filtered directly into rental pricing. Many tenants simply can't shoulder the annual rent increases tied to these insurance hikes. As a result, people are looking for cheaper alternatives in nearby counties such as Clay and Nassau. The Bureau of Labor Statistics also highlights slower job growth in Jacksonville's core industries: logistics, finance, and healthcare. Wages haven't kept up with the rising expenses of daily life, which means fewer renters can afford the newer, high-end Class A apartments flooding the market. And then there's supply, a lot of it. From 2020 through 2024, Jacksonville approved thousands of new rental units, a construction pace that far exceeded the actual rate of population growth. As these projects finish and come online, the city is being hit with a wave of new housing all at once. Zillow's rental trend data confirms that asking rents are falling in multiple neighborhoods, including Mandarin, Arlington, and the Beaches. Many landlords who aggressively raised rents between 2017 and 2022 are now reversing course, cutting prices to avoid empty units. Number 4. Tampa, Florida. Tampa's rental market didn't ease its way into a slowdown in 2025. It hit the brakes almost instantly. For years, Tampa ranked as one of the most in-demand cities in the entire country. Remote workers arrived in huge numbers. Investors poured money into real estate, and developers were convinced the boom would last forever. But according to Apartment List, Tampa is now seeing one of the most pronounced rent declines anywhere in Florida. And the reason is surprisingly straightforward: an overwhelming surge of luxury units all hitting the market at once. During the pandemic-era high, builders invested billions into new developments. Downtown Tampa, West Shore, Channelside, Water Street, and even suburban areas like Wesley Chapel and Brandon experienced a massive wave of large apartment complexes. Many of these projects were high-end Class A buildings packed with amenities, rooftop pools, structured parking garages, co-working spaces, and price tags often pushing above $2,000 a month. Developers assumed the influx of high-income professionals seen in 2020 and 2021 would continue indefinitely. But the market shifted dramatically. CoStar reports that over 14,000 new rental units were delivered across the Tampa Bay region in just 2 years, one of the largest bursts of supply the metro has ever seen. Demand, however, didn't keep up. Insurance premiums soared, property taxes climbed, and the overall cost of living began outpacing wage growth. Many renters started looking farther inland for cheaper housing options. Even Tampa's strongest employment sectors, healthcare, finance, and logistics, couldn't fully absorb the huge number of new apartments coming online. Vacancy rates in downtown and West Shore have now jumped to multi-year highs. Luxury properties that once expected waiting lists are struggling to fill units. Concessions are suddenly everywhere: 1 or 2 months free rent, reduced parking fees, lower security deposits. Some buildings are even promoting short-term leases just to bump up occupancy. Zillow's most recent numbers show that asking rents are dropping across nearly every central Tampa neighborhood. The city has moved into a genuine reset phase, the kind of adjustment Tampa hasn't experienced since the period following the Great Recession. Tampa isn't falling apart, but it is undeniably dealing with the consequences of overbuilding. And in 2025, landlords who once boasted about never-ending demand are working hard to keep tenants from packing up and moving elsewhere. Number 3. Orlando, Florida. Orlando has traditionally ranked among the priciest rental markets in the entire state. Fueled by massive global tourism, steady migration, and a heavy dependence on short-term rental investments, the city saw rent prices skyrocket from 2019 through 2022. But in 2025, that story has taken a dramatic turn. CoStar's latest data shows that Orlando is now seeing some of the sharpest jumps in vacancy rates anywhere in the Southeast. One of the main reasons behind this shift is the unraveling of the short-term rental industry. Thousands of investors bought homes throughout Kissimmee, Davenport, and Horizon West, assuming Airbnb demand would stay strong forever. Instead, insurance premiums surged, occupancy rates dropped, and city regulations tightened. With nightly rental profits evaporating, many owners were forced to convert their properties into long-term rentals, flooding the market with supply. At the same time, developers never slowed down. Between 2020 and 2024, the Orlando Metro approved tens of thousands of new apartment units, especially in booming areas like Lake Nona, Winter Garden, Mills Park, and the downtown core. These projects were planned during peak population growth, but according to the University of Florida's Bureau of Economic and Business Research, immigration slowed sharply by 2024. That means far fewer new renters are entering the market today. Tourism spending is shifting as well. The theme parks are still drawing huge crowds, but inflation has pushed visitors to spend less money once they arrive. A softer hospitality sector results in fewer workers with reliable incomes, and therefore fewer stable renters. Zillow's rental index shows clear year-over-year declines across much of Orlando, with some neighborhoods seeing drops of up to 7%. Large apartment communities are responding by rolling out aggressive incentives, move-in credits, more flexible lease options, and significant first-year rent discounts. Vacancy levels are now at their highest point in many years. CoStar reports that multiple submarkets across the metro have now crossed the 10% vacancy threshold, a level Orlando hasn't seen in more than a decade. The city remains one of the world's top tourism capitals, but its rental landscape is being reshaped by excess supply, fading investor confidence, and a wave of former vacation rentals hitting the long-term market all at once. In 2025, Orlando is undergoing a deep and widespread reset, one that is still very much in progress. Number 2. Fort Myers, Florida. Fort Myers was practically the symbol of Florida's pandemic-era migration boom. It became the place everyone seemed to be running toward. Remote workers escaping northern lockdowns, retirees chasing warm weather and affordability, and families looking for a fresh start. Home prices exploded, rents rose faster than almost anywhere else in the state, and developers scrambled to build as if demand would never run out. But in 2025, Fort Myers is experiencing a dramatic shift. The city has turned into one of the most oversupplied rental markets in Florida, and the impact is hitting much faster than many predicted. Zillow and Realtor.com analytics show that asking rents in Fort Myers have fallen sharply over the last year. And according to CoStar, vacancy rates across Lee County have jumped into double digits as thousands of new units enter the market all at once. Apartment complexes that used to fill as soon as they opened are now struggling to find tenants. Some buildings actually have more empty apartments today than they did during the Great Recession. The core issue is supply, far too much of it. Between 2020 and 2024, Fort Myers approved more than 10,000 new multifamily units, marking one of the heaviest construction periods in the city's history. Developers assumed population growth would continue at the extreme levels seen during the pandemic, but the pace has slowed significantly. Research from the University of Florida shows that in-migration into Southwest Florida has cooled every year since 2022. Job growth has also leveled out. Sectors that once fueled a steady stream of new renters, like construction, retail, and healthcare, are now expanding much more slowly. Rising insurance premiums and growing concerns about hurricane risk have become major deterrents as well. Instead of rushing to the coast, many would-be renters are choosing inland areas with lower costs and fewer climate-related worries. All of this has left Fort Myers landlords scrambling. Concessions are becoming standard across the county. 2 months of free rent, reduced parking fees, zero deposit move-ins, and long-term lease discounts. Investors who purchased properties during the peak boom are now cutting prices aggressively to avoid months of vacancy. Fort Myers isn't collapsing, but it is unmistakably overbuilt. Too many luxury communities, not enough renters, and a market that once looked unstoppable is now going through a painful correction that could linger for years. Number 1. Cape Coral, Florida. Cape Coral claims the top spot, and by a wide margin. During the pandemic boom, the city experienced one of the most explosive rent increases in all of Florida. Between 2020 and 2022, rental prices skyrocketed at a pace that ranked among the fastest anywhere in the United States. Investors poured in from every corner of the country, snapping up homes at record highs. Developers shifted heavily toward upscale rentals, convinced demand would continue endlessly. But in 2025, Cape Coral is dealing with a dramatic and painful reversal. The city has now become one of the most oversupplied and rapidly weakening rental markets in the state. Zillow's rental index shows year-over-year drops that rank among the steepest in Florida. CoStar reports that vacancy rates have climbed to some of the highest levels seen in any Florida metro, particularly in areas along Pine Island Road, Veterans Parkway, and the fast-growing Northern Corridor. The root issue is straightforward. There are far more available units than people looking to rent them. A major contributor to this imbalance is the enormous amount of new construction. From 2020 to 2024, Cape Coral added thousands of new homes and rental developments, built under the assumption that the migration wave would never fade. But the reality changed quickly. Insurance premiums surged, hurricane risks became impossible to ignore after recent storm seasons, and property taxes climbed. These cost pressures pushed many would-be renters away from coastal Southwest Florida entirely. Migration has slowed dramatically, job growth has softened, and the investor-driven frenzy that once defined Cape Coral has largely evaporated. Now, thousands of units owned by individual investors are competing directly with large apartment communities, driving rents downward faster than the city has ever experienced. Landlords are offering deals that would have been unthinkable just a few years ago: discounted first-year rents, deeply reduced renewal rates, free months added to leases, and even fully furnished units with no additional charge. The incentives grow more aggressive as vacancy numbers rise. Cape Coral remains a strikingly beautiful coastal community, but its rental market is undergoing a correction so severe that it stands out as the most extreme in Florida. The boom is over, and 2025 has become a year of reckoning for the region. Florida's rental landscape is being rewritten in real time. For years, rents climbed beyond sustainable levels. But now, in 2025, the reset has officially begun. Some cities will bounce back. Others may struggle for much longer. If you want to stay ahead of the biggest shifts happening across America's housing markets, make sure you're subscribed to Discover the Cities, where we break down every major economic trend, city by city. Stay informed, stay alert, and be prepared.